Welcome, everyone. Today we're going to put some conventional wisdom under the microscope. We're jumping into a really detailed, data-driven case study that compares two of the biggest players in the passive income world, physical real estate versus equity ETFs. The big question we're trying to answer is, which one really offers the best blueprint to escape the daily grind? For generations, owning property has been pitched as the most solid, reliable path to financial freedom. And for good reason. It's tangible, it's familiar, and it's been the foundation of wealth for a lot of people. But in today's market, is that still the whole story? Is it really the ultimate blueprint, or could there be a more efficient, maybe even a more truly passive alternative out there? Well, that's what we're here to find out. All right, before we get into the really interesting stuff, we have to do the quick legal housekeeping. So, just to be clear, this entire case study is for informational and educational purposes only. Nothing here should be taken as financial, real estate, tax, or legal advice. We always encourage you to consult with licensed professionals who can give you guidance tailored to your specific situation. And of course, please, always do your own research. And one last thing, none of the ETFs we're going to talk about are sponsors of this content. This is all based on our own original research using data that's publicly available, just to make sure we're keeping this comparison as unbiased as possible. So here's our game plan for today. First, we're going to explore why real estate has such a magnetic pull on us from a psychological angle. Then we get to the main event, a 3-year data showdown between the two strategies. After that, we'll uncover some of the hidden costs and returns that don't show up on a spreadsheet. We'll look at a different path to income. And finally, we'll tie it all together to help you think about your own personal financial freedom blueprint. Okay, let's get right into it. The whole goal here is to put two very popular blueprints for financial independence side by side. You've got one path that's tangible, something you can literally walk into and touch, and the other path exists mostly as numbers on a screen. The question is, which one actually performs better when the main objective is creating a steady, reliable monthly income stream? And this quote just hits the nail on the head. It perfectly captures the core challenge we're looking at. There's this deep, almost primal comfort that comes from owning a physical asset. This idea is really the perfect setup for understanding why real estate has such a powerful hold on our imaginations as investors, even before we look at a single piece of data. So let's really unpack that. Why are so many of us, particularly in places like the US and Canada, almost culturally wired to see property as the gold standard of investing? It actually goes way beyond simple math and returns. It gets into how our brains are built to handle things like risk, control, and that feeling of security. This slide does a great job of breaking down that powerful feeling. First up, you've got tangibility. You can't stand inside a stock certificate, but you can stand inside your rental property. You can see it, touch it. That realness makes the investment feel so much more secure than owning a tiny fraction of a company you might never even visit. Then there's the huge one, a sense of control. You pick the property, you screen the tenants, you set the rent, you decide to paint the walls. That feeling of agency is incredibly empowering compared to just passively holding a stock and hoping for the best. Next, there's the slower feedback loop. A property's value isn't flashing up and down on your phone every second of every day. And that lack of constant noise can be a really good thing because it prevents us from making emotional, panic-driven decisions. The cash flow narrative is also so simple and compelling. My tenant's rent pays my mortgage and my expenses, and I pocket the rest. It's a story that just makes intuitive sense. Number 5 is leverage and identity. You get to control this big, expensive asset with a relatively small amount of your own money down. And in doing that, you become a landlord, an identity that feels much more substantial to many people than just being an investor. 6th is social proof. We all know somebody, a friend, an uncle, a coworker, who crushed it in real estate. That story gets told over and over, reinforcing the idea that this is the proven path. And finally, there's a built-in commitment. It's expensive and a huge hassle to sell a house. And that friction actually forces you to think long-term, which is often the key to successful investing anyway. Understanding all these psychological drivers is so important before we dive into the raw numbers. But now it's time to pivot. We have to move from those feelings and that psychology to the cold, hard facts. How did these two different blueprints actually perform over the last 3 years? Let's set the psychology aside for a moment and just let the data do the talking. Okay, so for this showdown, we are starting with a hypothetical investment of $400,000. We're looking at a 3-year window from March of 2023 to March of 2026. And here's a really critical assumption for our case study. We're assuming the investor is living on the cash flow. That means any dividends or income are not being reinvested. This setup allows us to focus purely on the income-generating power of each strategy. All right, let's really dig into this first table for the U.S. market. Up top, we have the do-it-yourself rental property. It saw a pretty respectable 12.5% increase in value, turning that $400,000 property into $450,000. And it was generating about $2,250 a month in cash flow. You know, a solid traditional result. Now let's look at the alternatives. The second line is VNQ. That's a real estate investment trust, or REIT ETF. You can think of it like owning a tiny piece of a huge portfolio of commercial properties, like office buildings and malls. It performed pretty similarly on price appreciation, but delivered a lot less in monthly cash flow. But here's where it starts to get really interesting. Look at SCHD. That's an ETF that holds a basket of high-dividend paying U.S. stocks. It saw more than double the price appreciation at 27.8%, and it generated significantly more monthly income. And then you got SPYI. This is an S&P 500 covered call ETF. Now, what these funds do is they hold all the stocks in the S&P 500, and then they generate extra income by selling contracts called options on those stocks. And you can see the result. While its price change was pretty similar to the rental, its monthly cash flow was just dramatically higher at nearly $4,000 a month. I mean, that is a life-changing difference in income. So let's just pause on that for a second. The most important point here is this. If you were just focused on growing your capital in the U.S. over this period, the high-dividend equity strategy more than doubled the performance of owning a rental property directly. Your initial $400,000 would have grown by over $111,000, compared to just $50,000 with a rental. That builds a much, much larger foundation for creating future income. And if monthly income is your number one goal, the absolute core of this blueprint to escape, the difference here is just staggering. The covered call ETF generated 77% more income every single month than the rental property did. That is an extra $1,733 hitting your bank account every month, all without a single phone call from a tenant about a leaky faucet or a broken appliance. Okay, so now let's shift our focus north and see how this story plays out in the Canadian market. We'll use an equivalent starting investment of 540,000 Canadian dollars, looking at the exact same 3-year period. Wow, okay, this is where the story gets even more dramatic. First, look at the Canadian DIY rental. It saw very, very weak price appreciation, just 2.5%. The cash flow is pretty similar to its U.S. counterpart. But now look at the Canadian real estate ETF, XRE. It actually lost over 10% of its value in 3 years. Your $540,000 would have shrunk to about $485,000. That's not what you want to see. Meanwhile, the high-dividend ETF, XEI, absolutely soared by 41%, adding over $220,000 to the initial investment. And then, the main event. Look at the covered call ETF, HIDIV. It grew by a massive 38.7%, while generating an incredible $6,243 every single month in income. The gap between property and equity in Canada during this period wasn't just a gap, it was a massive chasm. Let that number sink in for a minute. A 41% increase in your capital versus just 2.5%. For anyone whose blueprint includes actually growing their net worth, not just producing a bit of income, the equity approach in Canada over this period was, without question, the superior path. This isn't just a small difference. This is the difference between meaningful wealth creation and basically just treading water, barely keeping up with inflation. And this number right here, this is the headline for anyone who is serious about trying to escape the grind. Over $6,000 a month. That is nearly triple the income you'd get from a rental property that costs the exact same amount of money to buy. This isn't just a better return on your investment, this enables a completely different lifestyle. This is the kind of cash flow that can truly fuel an early retirement or a nomadic life. But here's the thing. Those tables, as dramatic as they are, don't even tell the full story. The cash flow numbers we used for the rental property were actually pretty generous. We really need to look beyond the top-line numbers and talk about the hidden costs, both the financial costs and the personal costs that come with these very different blueprints. And this right here illustrates the real day-to-day difference. With a DIY rental, that monthly rent check you get is really just the starting point. You have what I like to call the 3 T's: tenants, taxes, and toilets. A pretty good rule of thumb is that 25 to 35% of your gross rent just vanishes into unseen expenses. We're talking property taxes, insurance, budgeting for vacancies, maintenance costs like a new roof or a water heater, and maybe even property management fees if you don't want to deal with it yourself. Your investment is also highly illiquid. It can take months and cost you tens of thousands in fees to sell. And it requires active management. Let's be honest, it's basically a part-time job. Now on the other side, you have the equity blueprint. It's highly liquid. You can sell your entire position in seconds for a tiny fee. The management is almost non-existent once you've done your initial research. And the fees are completely transparent and very low. It is, by its very design, truly passive. So when you combine the superior performance data from this period with the lower hidden costs and the significantly lower effort required, a different path to income starts to look incredibly compelling. It really forces us to take a step back and reevaluate what the ideal blueprint for financial freedom actually looks like in today's world. Okay, let's just quickly summarize the crucial takeaways from all this. First, over this 3-year period, equity ETFs delivered superior total returns in both the US and Canada. For pure income generation, the covered call ETFs produced far more monthly cash flow. And it's really interesting to note that even the real estate ETFs, the REITs, underperformed the direct equity ETFs. The bottom line is that the equity blueprint offered higher returns with way less hassle and fewer hidden costs. And, perhaps the biggest takeaway of all, that powerful psychological comfort we get from real estate didn't actually line up with the financial data during this specific period. And all of this brings us to the most important part of our case study today. What does this all mean for you and for your personal blueprint to achieve financial freedom? Now, this whole analysis is not about declaring one strategy as universally better than the other. Real estate has created an immense amount of wealth for many, many people over the long term. But what this 3-year snapshot provides is powerful evidence that there are very compelling alternatives out there, alternatives that might just be more efficient, more liquid, and ultimately more passive. So does seeing these numbers laid out side by side challenge any of your own assumptions? We would genuinely love to hear your thoughts down in the comments. Let us know if this changes how you think about financial independence, passive income, or designing your own path to early retirement. If building your own blueprint for financial freedom is a topic you're interested in, please do us a favor and hit that like button and subscribe to the channel. Around the 20th of every single month, we release our full, transparent income portfolio, sharing every holding and the strategy behind it. It's a fantastic way to follow along on a real-world journey towards generating passive income. Make sure you turn on notifications so you don't miss those updates. Thanks so much for watching.